Good morning, everyone. Hope you are all well. All right, so where do we stand at this point? Okay, so everyone is aware that we are having our midterm this coming Thursday, and the midterm is going to be covering chapters Appendix C and Appendix C through Chapter 16. Okay, and we are going to continue with Chapter 16 today, and we are going to go over the homework exercises for Chapter 16. Okay, so we have the midterm coming up. We're going to start Chapter 17, but before we start Chapter 17, I wanted to give you a bit of a review of what you can anticipate for the midterm on Thursday. Okay, so the midterm will be for 1 hour and a half, and it's going to include 30 multiple choice questions, calculations, as well as theory questions. Okay, all right, and then we have about 2 chapters, Chapter 17, which will finish before Thanksgiving, and then Chapter 20, I believe. We'll have, and Chapter 21, which is the last chapter, is a light chapter. It's just a couple of ratios. Okay, so we've completed a lot of the coursework, so that is a good thing for this semester. Also, if we look at our Apple investment, we know it has been one turbulent semester in the stock market. Last time that we met, actually it's been around, yesterday was a good day. Actually Apple, our share of stock was selling at $119.83 last Thursday, and it's actually selling at $119.51 today. Okay, so now it's hovering at about that same amount. So we'll see. We know, Lysander, yes, the exam will start at 10:05. Okay, it begins at 10:05 and it will run for 1 hour and a half. Okay, and I'll be doing a bit of a review for that. And let's see, anything else that I have to tell you? No, so we'll just move forward from here. And again, no makeups. Okay, you have to be here for the midterm unless you have some type of documentation, as to why you missed it. Okay, because we have to be fair to everyone. Okay, we want everybody to have that same fair shot. All right. So far for Chapter 17, I'm sorry, for Chapter 16, we had been dealing with management accounting. Okay, and when we were dealing with management accounting, we had a large emphasis on, and here I'll pull up a blank screen just for a moment of review. Remember that this chapter we talked a lot about product costs. Okay, and again, it was we contrasted product costs, with period costs. Okay, now remember, when we are discussing, when we're discussing product cost, which costs are they again? 3 costs that must be incurred in the factory setting. Anybody who remembers? Come on, guys, you know this. The 3 product costs. Okay. Lysander, I'll pick on you. I know you're there. 3 product costs. Very good, Daniel. Overhead, Lysander, very good. Manufacturing overhead, direct labor, very good. And direct materials, very good, guys. Okay, so I knew you were out there. So, and the way that I want you to think of it, okay, in the order is product cost must be incurred in the factory setting. Okay, the first product cost is direct, let's say is direct materials. Okay, we know direct materials are those materials that are directly traceable to the final product. That is, you can actually see it going into the construction of whatever that final material, whatever that final product is, whether it's a bicycle, a car, whatever. Okay, so if it's not direct material, okay, then it may be direct labor. Okay, remember, to qualify as a direct labor, it must be, these individuals must be paid on a hourly wage basis. Okay, and they must have hands-on contact with the final product. They must be adding value to that final product. Okay, and be paid an hourly wage. If the cost is incurred in that environment and it's not direct materials and it's not direct labor, okay, then it is going to be considered manufacturing overhead. Okay, so that is the checklist you go through in your mind, all right, as to what product costs are. Okay, and then again, some examples of manufacturing overhead. It's going to be indirect materials. Okay, indirect labor, all incurred again in the factory setting. Indirect labor, indirect materials, indirect labor, factory depreciation. Expense. Let's see, what else? Factory utilities. And then finally, factory security guards. Okay, all of these would be considered and be charged to their salary. Very good. The salary for factory security. Yes. Okay, and in always that would be the cases. They wouldn't be paid a wage, but yes, they would be. It would be their salary. Also, salaries for supervisory personnel. You know, people who are supervising the employees on the assembly line. Okay, so that's the checklist you go through in your mind. Okay, remember, when we talk about selling and administrative costs, those costs are anything that would be considered general selling and administrative costs. Okay, so any cost that's incurred outside of the factory setting, that is going to be charged to general selling and administrative expenses. And remember, these type of expenses are considered operating expenses. Okay, and where are they deducted on the income statement? If they're operating expenses, where are operating expenses deducted on the income statement? Deducted from that not from cost of goods sold. A little bit of that. Remember that subtotal operating income? No, these are operating expenses. They are going to be subtracted from the gross profit. Okay, they are deducted below gross profit. Okay, to arrive at the net income. Remember, when you have any of these when you have any of these product costs, remember, product costs are going to flow from the inventory account on the balance sheet. Okay, they basically are going to flow through the inventory account on the balance sheet. They're all going to be accumulated there. And then when those products are finally sold, that's when we're going to see the cost of those products appearing on the income statement under cost of goods sold. Okay, so that is the flow of cost through the manufacturing cycle. Okay. All right, so remember they're always separate. These period costs, again, don't get inventoried. They don't get capitalized. Okay, they're going to be deducted directly from the gross margin or gross profit. Okay, so just a little bit of an overview. Remember that if you're walking down the street and somebody asks you, okay, how many inventory accounts does a merchandiser have? You know that, I'm sorry, how many inventory accounts does a manufacturer have? 3. Excellent, Francisco and Lysander and Daniel. Very good. A merchandiser will always have 3 inventory accounts. Okay, and each of those 3 inventory accounts, remember, are going to appear on the balance sheet. Okay, the first one is raw materials. Raw materials. Then after raw materials are placed into production, work in process. Very good, Daniel. Work in process. Okay, and then finally finished goods. Okay, and then again, once those finished goods are completed, that's when they will then be transferred. Once they're sold, that's when their cost will be transferred to the cost of goods sold. Okay. Remember, what are the 3 elements? Okay, what are the 3 elements of product costs that are going to be charged to the work in process inventory? The 3 elements of product cost. We know we have the raw materials. Okay, once that's placed into production, it's going to be debited to the work in process inventory account. Okay, and what else is going to be debited to the work in process inventory account? We know direct labor applied. Okay, direct labor applied to production. Okay, as well as manufacturing overhead. Overhead applied as well. Okay, so if you understand these flows, these different accounts, all new accounts really that we're seeing when we deal with a manufacturer. Okay, if you understand the flow of all of this, then you understand this chapter. Okay, questions? All right, very good. So now we'll go over the exercises for this chapter just to increase our understanding a little more. So for those of you who remember, for the midterm, I would definitely go over all the homework exercises. They're all separate on under the materials section of Blackboard. So if you just want to review them separately, and then also, of course, all the slides are available too. Okay, so now pay close attention, okay, because this will clear up any inconsistencies or any confusion you have. Okay, so here, brief exercise 16.1. During the year, Coronado Boatyard has incurred manufacturing costs of $420,000. Okay, all right, so that's understandable. We know when they refer to manufacturing costs, we know what they're talking about: direct labor, direct materials, and manufacturing overhead. Okay, and they have been building 3 large sailboats. So at year end, each boat is approximately 70% complete. Okay, so how much of these manufacturing costs should be recognized as expenses in Coronado Boatyard's income statement for the current year? Okay, and now this might go against what your first thought may be, but remember, it's only when the goods are sold, okay, that those costs then can be charged to the income statement. In this case, okay, the boats are only 70% complete and they have not yet been sold. Okay, so how much of that cost of the $420,000 is on the income statement? And the answer is zero. Okay, Coronado Boat should not recognize any of the manufacturing costs on their year-end income statement. Okay, they're product costs, but so they're not going to appear there until they're sold. Okay, now, as a backup question, where would the costs for these 3 boats that are still under construction, okay, where would the cost for those 3 boats appear on the balance sheet? In which account then? They haven't been completed yet, all right? So they're not going to be in the finished goods, okay? Where would they be? In the inventory, and specifically the work in process inventory, Kristen, excellent. They're going to be included in the work in process inventory. Remember, it's not until they're actually sold, okay? Or it's not until they're actually completed, then those costs would be transferred to the finished goods inventory. Okay, so make sure you read slowly and carefully, okay, when you have problems and when you have the midterm and final. Okay, all right, good. So let's go to brief exercise 16.2. So brief exercise 16.2 discusses direct materials used. All right, so during the current year, the cost of direct materials purchased by a manufacturing firm was $340,000. All right, so let's put this, when you have a question like this, again, put it in a T account format, okay, because it will make it easier, it'll make it easier to figure out. All right, so what are you told here? All right, in this particular instance, the amount of direct materials purchased by this firm was $340,000. So you know that this firm, when they purchased the direct materials, they debited the direct materials general ledger account for $340,000. Okay, but what happened here then? And the direct materials inventory increased by $65,000. Okay, so they purchased $340,000. All right, but we also know that the ending balance of the direct materials was $65,000 greater than what it was before. All right, so what are they asking you? What was the cost of the direct materials used during this year? That means how much was credited to the direct materials account, okay, and then debited to the work in process inventory account, given this information, and that's all we have. Okay, so what you would do in a case like this, you would take the amount of purchases, which is $340,000, and you would subtract what you know you didn't use, okay, the ending balance in that account. Okay, so always doing this type of, when you're in doubt, do the general ledgers, do the T accounts or the journal entry. Here, if you did the T account, you would see you would have to subtract these purchases from the ending inventory to come up with the answer of $275,000. Okay, that was the amount that was placed into production. Okay, questions? All right, and again, if you wanted to do the journal entry, what would be the journal entry here? Okay, because again, we're going to be dealing with these manufacturing costs. This is something new. What would be the journal entry when I transfer the cost? All right, so here I know that we used $275,000 worth of direct materials for this year. So that means when direct materials is used, I'm taking it out of the direct materials and placing it into the work in process. So the journal entry would be work in process, okay, is going to be debited for the $275,000. Okay, and which account is going to be credited here? Okay, when I'm transferring inventory, excellent, direct materials, Daniel, direct materials is going to be credited because I'm decreasing the amount of materials that I have in storage now. Very good. Okay, so when you place materials into production, that would be the journal entry. And now, Dante, Okay, so we're told here, all right, that the amount of direct materials that were purchased by this company, okay, was $340,000 for this year. Okay, so when the direct materials were purchased, how did that affect the direct materials account? Okay, for how did it affect the direct materials general ledger? The direct materials general ledger was debited for $340,000. Okay, now we also are told, okay, that the direct materials inventory increased by $65,000 this year. Okay, so that's the ending inventory, okay, increased by $65,000. Now we know, okay, in this instance, we're not told what the beginning inventory is, but what do we know? We do know that the ending inventory equals $65,000. Okay, so we see here, this is the amount that was purchased. This is the amount that was not used. Okay, that's the amount that wasn't placed into production. Okay, so how do we figure out how much of direct materials were used? We subtract from the purchases. We subtract out whatever remains in the ending inventory, which is $65,000, and that's how we got to the $275,000 debit to work in process inventory. Okay, Dante, does that make sense? Okay, very good. All right, always, again, just put it either, put it in a general ledger format. If it decreased, that's right. If it decreased, we would have added it. Okay, very good. All right. So let's now, and again, that could be an option for a question. Okay, and again, now we have brief exercise 16.3. Okay, now read carefully. Okay, if you, oh no, I was going to say bring highlighters, but it's on a screen. So just read carefully. All right. So a company that assembles trucks and they produce 60 trucks during the current year. Okay. So please pay attention. Very good. And you see how the whole manufacturing process is very different from what you've been studying up until this point. Okay, so here a company assembles trucks and they produced 60 trucks during the current year. Okay, and they incurred in the production of those 60 trucks 84.5 million of product costs. Okay, 84.5 million of direct labor, direct material, and overhead. But now, again, they produced 60 trucks, and 53 of those trucks were sold during the year. Okay, and they're each identical. They're allocated the same amount of cost. So while they manufactured 60 trucks in total, they only sold 53 of those trucks. Okay, so the question is, how much of the 4.5 million in product cost should be allocated to the income statement? Okay, so what you have to figure out in this instance, you know the total product costs are 84.5 million. Okay, but that was spread out over 60 trucks. So the first thing you do to figure out how much the cost of goods sold is you take that, you take the 84.5 million. Okay, I'm sorry, how much of the 4 million in assembly cost, I'm sorry. So they had 84.5 million of product cost, but they also had assembly costs. So those assembly costs are direct labor costs. Okay, you assume it's direct labor or robotic labor. If the 4.5 million in assembly costs, how much of that should appear on the income statement for the current year? Okay, so what do you have to do? So again, you have to read carefully. So you take the 4.5 million in assembly costs, and now you have to figure out because remember, those 60 trucks are completed. Okay, you're going to divide the total assembly cost by the number of trucks completed. Okay, so here, what would you do? You would, okay, very good, Tante. Hold on to that. You're gonna bring it home. That's how we bring home that question. Very good. So the 4.5 million divided by 60 equals $75,000. So each truck okay, that is completed should be allocated $75,000 of assembly costs. Okay, but we only sold 53 of those trucks. Okay, so the 53 trucks times that were sold times the 75,000 per truck in assembly costs equals 3,975,000. That is the amount that is going to be charged on the cost of goods sold, okay, as assembly cost, as part of the cost of goods sold. Okay, questions? Okay, and Dante, that's an excellent question. His thought is, but wait a minute, okay, so 53 trucks, the assembly cost for that is included in cost of gold on the income statement. What about the 7 trucks that are completed, but they have not yet been sold? Okay, where do the costs for those exactly? They're still sitting in that finished goods inventory account, exactly. Okay, they're still balance sheet accounts until they're sold. Okay. Good, Dante? That's a very great way to logically try to understand. Okay, but wait a minute, what does that mean? Okay, very good. Okay. All right, so no questions? All right, so let's move forward now with the next one. All right, so remember, manufacturing overhead, and actually the next chapter that we're going to go over is completely based on manufacturing overhead. Okay, and remember what I said, manufacturing overhead is typically the largest product cost that is incurred by a manufacturer. Okay, because again, it's in a factory, it's not direct material, it's not direct labor, so it's that catch-all. All other factory costs that are not direct materials and direct labor. What I want you to remember, and again, you only have to know through this chapter for our midterm Thursday. What you have to remember is that only actual costs, okay, only actual manufacturing costs are debited, okay, to the manufacturing overhead account. So actual costs are debited to manufacturing overhead, okay, and whenever those costs are applied to the work in process, okay, when they're applied to the inventory account to work in process, that's when we're going to see a credit to the manufacturing overhead account. Okay, so over the course of the year, okay, every time an indirect material cost, indirect labor cost, anytime a cost other than direct labor or direct materials is incurred in the factory, that cost is going to be debited to manufacturing overhead. Okay, it's an account that's utilized throughout the entire year. Okay, and then over intermittent times during the year, okay, management will then credit the manufacturing overhead costs to the work in process inventory account. Okay, also remember, all right, that at year end, okay, at year end, we want the balance in that manufacturing overhead account to equal 0. Okay, we want that account to equal 0. So that means then that all the manufacturing overhead costs have been applied to all of our products during the current year. Okay, so that's just something to keep in mind. So here, in this particular instance, and this is exactly how you record information in the manufacturing overhead account. Okay, so during the year, CF Manufacturing Company incurred $375,000 in indirect labor costs. So we know that $370,000 is going to be debited to the manufacturing overhead account. That's an actual overhead cost. Okay, we also know that $15,000 of indirect material was incurred. So that $15,000 of indirect materials, okay, remember that's like oil, grease, glue, something that we really can't and don't want to track on an item by item basis to production. We know that $15,000 is going to be debited, okay, to that manufacturing overhead account as well. Okay. In addition, $163,000 of other overhead costs, okay, were also incurred this year. That $160,000, these were all actual overhead costs. They are going to be debited. Okay, so here, if I totaled out what the manufacturing overhead, the actual cost of manufacturing overhead for this year was, I would get a total of $548,000. Okay, that was debited. Okay, now here we're told additional information. This company also incurred $125,000 in rent house. Okay, in rent cost. And this is a tricky one. Okay, you'll see this. I would say you're going to see at least once on the midterm or the final, this type of question. Remember what I said here. Okay, this company also incurred $125,000 on rental costs for storing finished goods. Okay, so what amount did CF Manufacturing assign to the work in process inventory account from the manufacturing overhead? Okay, and now if you see here, you see that $125,000 in rent, okay, for storing the finished goods, we did not see that being charged here. Okay, the cost we see being charged here total $548,000. Okay, so then, okay, since we want the manufacturing overhead account to equal 0 at year end, we know that we had to have credited, okay, the manufacturing overhead account over the course of the year. And usually it's done at least on a monthly basis. Okay, so now, just for argument's sake, when we credited that manufacturing overhead account, okay, when we credited that manufacturing overhead account, what was the journal entry? We debited the work in process account, okay, for that same $548,000. Okay, and then what did we credit? We credited the manufacturing overhead account. Okay. And remember, why do we do that? We're transferring the cost, okay, from that manufacturing overhead account. We're transferring those costs to the work in process, because now it becomes part of that inventory account work in process. Okay, because we wanted to end up with a 0 balance, we know we had to have performed this journal entry, a total of that journal entry, which basically transferred all of the manufacturing overhead costs to work in process. And this is always the journal entry. Okay, now question, okay, why didn't, okay, this $125,000 in rental costs on a warehouse which stored finished goods, why wasn't that expense charged to manufacturing overhead? Does anybody remember? I'll give you a hint. If I told you that it was a rental cost for direct materials, a direct material warehouse, it would have been included here. Okay, but the fact that it's rental cost for a finished goods warehouse, remember, a finished goods warehouse does not add any value. Okay, those goods, let's say we're storing cars that we manufactured in this big warehouse. Okay, when those cars are sitting in the warehouse waiting to be sold, exactly. Since the raw materials was part, when it was placed into production, very good, Joshua, that was part of the manufacturing process. Okay, when the goods are the finished goods are just sitting in a warehouse, nothing is happening to them. There's no value added to those products that are in final storage. Okay, so the cost for the final storage facility for finished goods, that is considered an operating cost. Okay, it would not be included in the manufacturing overhead. Okay, that's one of those tricky points. Okay, that always comes up, hint, hint. Okay, because again, if it's raw material storage, yes, that gets included here in manufacturing overhead. If it's work in process storage, these cars that are half put together, you know, but they're not completed production, the cost of that warehouse, yes, would be included in manufacturing overhead. But if they're finished goods, Okay, the amount of rental costs for that storage material, for that inventory storage is not manufacturing overhead. It's just charged as a period cost. Okay. All right, and remember, in these times of just-in-time management, and in times where companies like Apple, they want to reduce the amount of finished goods inventory they have. Okay, this is in line with that philosophy. You don't want to have these huge amounts of inventory sitting around, okay? Because remember, inventory shrinkage, it can get damaged, lost, stolen, etc. So finished goods costs for storing them, again, are charged as an operating expense. Okay? All right, so if you understand these problems, these are really, really good examples for this chapter. Okay, questions? Okay. All right, if there are no more questions, we will forge ahead. Okay, the next problem. All right, so this is a really good reminder. Okay, so if you can, just block out the answers. Okay, when we get to the next problem, but here, just as a little summary, remember, only product costs are debited to manufacturing overhead. Okay, only product costs are debited to manufacturing overhead throughout the year. Rent associated with finished goods is a period cost. It does not add value. Thus, in order for the manufacturing overhead account to have a zero balance, okay, manufacturing overhead of $548,000 must have been assigned to work in process. Okay, and that's what we saw in the earlier journal entry. Okay, this would not have been debited. This cost for storage of finished goods would not have been debited to manufacturing overhead. All right. Okay, so let's go on. Exercise 16.3, a great review exercise. I don't know if any of you are interested, but I really think I always loved cost accounting. I taught cost accounting in the past also. You see, it's very different. It's fun. It's analysis. Hopefully some of this manufacturing sector will come back in the United States. So again, something to think about. Okay, always make sure you pursue a career that you're interested in. Okay, that you don't just do it for salary. I know a lot of kids, especially when I first started teaching, like in the early 2000s, everybody was a finance major. Everybody wanted to be a finance major. You thought, okay, those people make the biggest bucks. I'm just going to go in, I'm going to be a slave for 10, 15 years, and I'm going to retire a millionaire. Okay, that's not what happens to everybody. Okay, and then again, things are cyclical. Okay, so what happened then in at the end in like the 2007, 2008? Remember, we had that big downturn in our economy. Okay, with the bankruptcies that we talked about, with the housing crisis and the mortgage loan business. So what happened? It was interesting because everybody wanted to be an accounting major then, which is smart. Okay, people didn't want to be finance majors because there were no more jobs in that field. They were cutting left and right on Wall Street in the finance companies. Okay, so again, build your resume based on where you see growth industries. Okay, don't go into a shrinking market. It just doesn't make sense at your young age. Okay. Okay, so here, indicate, to go on exercise 16.3, indicate whether each of the following would be considered a product cost or a period cost. Okay, remember, product cost is going to be charged to cost of goods sold when it on the income statement when it's sold. Okay, again, a period cost is charged against revenue in the current period. It has no future benefit to the corporation, so it is charged against revenues during the current period. Also, furthermore, if you identify it as a product cost, indicate whether it's a direct product cost or an indirect product cost. Okay, you guys know this. Okay, what are the indirect product costs? Okay, what is an indirect product cost? Okay, or somebody else tell me what are the direct product costs? Lysander, go.
Wages.
Okay, so the direct product costs are direct labor.
Yeah, direct
And what?
labor, direct materials,
Very good. Direct labor and direct materials, very good, are
and
going
overhead.
to be the direct product cost. No, direct labor and direct materials are the direct product cost. So
Oh,
product cost is the indirect product cost?
oh, overhead.
Exactly. All right, so think of it in those terms, okay? The ones that say direct are the direct product cost, direct materials, direct labor, and the indirect product cost is manufacturing overhead. Okay. Again, makes
Now,
sense, very logical. I'm sorry? Did somebody have a question? Okay. All right, so let's go through this. This is fun. Okay, so cost of disposal of hazardous waste materials to a chemical plant. Okay, not direct labor. It is in a chemical plant. Okay, so we know that basically it's in a plant setting. Okay, it's something that just gets generated in the production. Okay, so where would that be charged to? It's a product cost. Okay, but where it's not occurring in an office. What type of product cost is it? It's an indirect product cost because it's going to be charged to manufacturing overhead. Okay. Second one, okay. Amounts paid, okay, by a mobile home manufacturer to a subcontractor who installs plumbing in each mobile home. Okay, so this one, okay, it's a manufacturing cost in manufacturing mobile homes. Okay, they're putting in plumbing. You know that you could trace the amount of plumbing you put into a mobile unit. So we know that it's a direct product cost and it's going to be a direct material cost. Okay, and the fact that if I'm the contractor, the fact that I hire a subcontractor to do it, they're just doing work that I would normally do. I just chose, maybe because it's cheaper, to source it out to a subcontractor. Again, it doesn't matter who does it. The fact that it's either a prime or the subcontractor, the fact is they're putting direct materials into production. So for the plumbing, so that is a direct material charge, okay, and a product cost, direct product cost. Everybody good? Don't get confused because it's to a subcontractor and say, well, since it's a sub, it's an indirect. No, the only indirect product cost is manufacturing overhead. Okay. All right, letter C. Depreciation, this is always a tricky one. Depreciation on a sales showroom and showroom fixtures. Again, a showroom is basically when you go into, you're buying a car, you go to a showroom, you see a bunch of cars there. That's not the factory. Okay, so since that cost is not being incurred in a factory, the costs on the showroom and the fixtures, the salesperson's salary, all of those costs are going to be period costs. Okay, and they're going to appear on the income statement as a period cost, as an operating expense. Okay, the next one. Okay, so, and again, security guards, because they're in both locations, it's always going to come up. Okay, so salaries of security guards in an administrative office building. Again, they're not in a factory. That's the first question. So what type of expense is that? That is their salaries are going to be a period cost. Okay, they're going to be deducted as an operating expense. Fine. Okay, salaries of office workers in the credit department. Okay, so in the credit department, again, that's an administrative office. So where are we going to charge those salaries to? Again, it's not incurred. They're not sitting in a factory. So it is also going to be a period cost charged against expenses, charged against revenues in the current period. Okay. Then here, depreciation on, okay, very different here. Depreciation on the raw materials warehouse. remember, since the raw materials, okay, raw materials are going to be taken out of the warehouse and then placed into production. Those goods do have an added value to the final product. So they are going to be charged, again, it's not a direct cost, direct product cost, okay, because it's not direct labor or direct materials, but it is manufacturing overhead. So that is considered an indirect product cost. Again, if I said depreciation, now here, just to bring that home, if I said depreciation on the finished goods materials warehouse, okay, if I said depreciation on the finished goods warehouse, okay, where would I be charging that expense to? If it were a finished goods warehouse, the depreciation on a finished goods warehouse, would that be that part of manufacturing overhead? Okay, who remembers? We just went over it. If it's the depreciation on a finished goods warehouse, come on, guys, that would be an operating expense. Okay, remember, since it's not a period cost. Very good. Okay, and it would be charged to expense in the current time period. Okay, so make sure you understand, since it's a little tricky, remember you understand that differentiation. Okay, very good. Okay, and then finally the last one, income taxes on a profitable manufacturing company. Okay, remember, income taxes have nothing to do with what's going on in the warehouse. Okay, so any income taxes are going to be charged as a period cost. Okay, and they get deducted as an expense in the current period. They are not a product cost ever. Okay. Questions? Okay, so we are going to go over the next exercise. I will tell you now, for those 33 of you who are here, there's going to be a problem very similar to this on the midterm. Okay, so you have to understand this. Okay, and again, once you do a schedule like this, you will be an expert because they are all treated similarly. Okay, so you remember, okay, if you're a manufacturer at the end of the year, all right, in order to figure out the cost of goods sold, okay, you are going to have to you're first going to have to determine what the costs of finished goods manufactured are. Okay, so to figure out, so here we're given this information. We're given the three different balances in our inventory accounts for Nutronics, a company. Then we're also told direct material used, direct labor charged, and selling expenses. Okay, and then the general and administrative expenses. Okay, realize right away that these two types of expenses are different. Okay, general and administrative and selling expenses. Right away you remember, oh, okay, I know those are charged as period costs on the income statement. Okay, and then it asks you here, we're told here that overhead applied to a production was $192,000. Okay, so that's the information. Now you have to figure out, okay, what do I do? How do I handle this? All right, so to figure out the cost of finished goods manufactured, remember you have to, the starting point is always going to be the work in process inventory for this year. Okay, you're trying to figure out how much, okay, how much of work in process, what was the pool of goods that were basically available for sale this year. So you start out with the beginning work in process inventory, not finished goods. We're trying to figure that out. We're going to start with the work in process inventory as of 1/1 of this year. Again, where did I get that from? I got that from here. I was given that information. And you'd always have to be given this information. You just have to remember what to do. Okay, so the $12,000, that's how much we began the year with work in process. Now, what got added to work in production over the course of this year? Okay, we know that direct materials used gets added to the work in production. So this $210,000 is going to be added here to the work in production. Okay. What else gets added? We know that direct labor, okay, because we're told here this was added to production over the year. That $120,000 of direct labor is going to be added also. Okay, and we also know that manufacturing overhead, okay, is going to be added for $192,000. Where do we get that from? That was given also. Okay, remember, selling expenses and general administrative expenses do not get added, okay, to any of the inventory accounts. They appear separately on the income statement. Okay, so this is beginning work in process. This is everything that we added to the mix, okay, over the course of the year. Remember that these three costs are the product costs, right? These are product costs that are added to the mix over the course of the year. This was our production. All right. So when we add those four amounts together, okay, the 12,000, that tells us that our total, so the total manufacturing costs for this year, that is direct labor, direct materials, and manufacturing overhead, equaled 522,000. When I add to that, what was the work in process at the beginning of the year? Okay, how much of total goods do we work on this year? $534,000. That was the total cost of goods that were in process at the over the course of this year. That was everything that was in the mix for this year. The beginning work in process inventory, then the direct materials, direct labor, and manufacturing overhead, which I applied. Okay, and I got those all from my general ledger balances. Okay, but what else do I know? I know that the amount of work in process at the end of the period equaled $8,000. Where do I know that from? Okay, again, I have to be given it. So I know that I began the year with $12,000 worth of work, these three accounts to my work in process, okay, and I ended up with a balance of $8,000. Okay, if 534,000 was the amount that was available, when I subtract for this year in work in process, when I subtract out what my ending work in process is, and I know how did I get that amount? That means my CPAs came in and they counted that I still had $8,000 worth of inventory in work in process at the end of this year. Okay, so what is the amount of my finished goods manufactured? My finished goods manufactured for this year equals $526,000. Okay, what happens? Okay, again, these costs are in my work in process inventory account. What is the journal entry after I figure out my cost of finished goods manufactured? What would I debit those costs to? These are the cost of finished goods manufactured. What would be the journal entry once I figure that out at the end of the year? Remember, it starts out as direct materials inventory, then it transfers to work in process inventory. But now I figure out not quite yet COGS. Okay, not quite yet COGS because I didn't say anything about selling them. So I'm taking them out of my work in process inventory, and I'm not cost of goods sold because I haven't sold them yet. You're forgetting that one last inventory account. Remember, work in process inventory, how it gets transferred to, that's it, Daniel. Ding, 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 ding. The finished goods inventory. Okay, so the cost of finished goods manufactured gets debited to the finished goods inventory account. Okay, once I do that account for $526,000. And then exactly, work in process gets credited. That's exactly right. Very good, Lysander. Then that, remember, now I have to transfer the cost. So that work in process, once I figure out the cost of finished goods manufactured, equals $526,000. And then, okay, Joshua and Kristen, then when I sell it finally, I would debit the cost of goods sold and then credit finished goods inventory. Okay, don't forget there's 3 inventory accounts. Okay, and then here, does everybody understand now that flow? Okay, again, you have to be given all this information. You just have to remember what the flow of it is. Okay, make sure you review this, okay? So that you know, you understand the process of doing it. And then here for B, you are asked also, assume that the company manufactures just a single product. So, okay, so they have one product and they're selling only these highlighters. What is the average per unit cost of manufacturing this product? The average per unit cost is going to be, take the $526,000 and divide it by the number of units that are completed, which is $20,000. Okay, and then you're going to take the 526,000, divide by the 20,000 units, so we come up with a per unit charge, okay, for processing of $26.30. Okay, that's the total manufacturing cost per unit. Okay, again, you still have your selling and administrative, but this is just the manufacturing costs that are allocated. Okay, and Lysander, yes, credited. This will be the journal entry. You said debited here, no, credited. Okay. Remember, the inventory account that you're transferring out of always has to be credited. The one that you're increasing has to be debited. And then just so that, because some of you brought it up, again, the last journal entry based on the number of units that were sold, you would debit the cost of goods sold inventory for however that much that you sold. I'm sorry, you would debit the cost of goods sold account, the expense account. Remember, cost of goods sold is an expense account. And then you would credit the finished goods inventory account. Or whatever the amount is that was sold. Okay, and again, if none of it was sold, you could not do this journal entry. Okay, so the debit to the cost of goods sold, always, yeah, and only when they're sold, yes. Only when they're sold. All right. All right, and remember that when costs are transferred from the stores manufacturing. Okay, so here, remember a work in progress is an inventory account as well. Okay, what gets transferred to the work in progress? Oh, actually, I'll do the journal entry here. The work in process inventory account. How was it increased this year? Work in process inventory account was increased by by $522,000 over the course of this year. Okay, and what was transferred to the work in process inventory account? Direct materials. Direct materials for 210. Again, they didn't ask us for the journal entries. I'm just showing you here. Okay. What else was transferred? I'll do it separately because that's how we've been doing it. Work in process. No, sorry, I won't do it that way. So work in process was transferred in, I'm sorry, direct materials of $210,000 was transferred into the work in process inventory account. Direct labor costs. Again, this is all given. Direct labor costs of $120,000 were also transferred into the work in process. They were applied to the work in process inventory account. And then finally, the last one, manufacturing overhead. Okay. Manufacturing overhead of $192,000. Okay. Was transferred into the work in process inventory as well. Okay, and that's, again, we were given that information, but this is the flow of the product costs. Okay, these three get direct materials, direct labor, manufacturing overhead, get applied first to the work in process. And then here, once the goods are completed, you have to prepare, you have to transfer the costs from the work. You have to prepare the cost of finished good manufactured, the schedule that we had above, and then you could do this journal entry. Okay, and on the exam would also be given, yeah, you would have to be given that information, yes. But you are going to be asked to figure out what the cost of goods manufactured are. Okay, so you'd be given that information, and you have to know the starting point is you have this year, and you have to put together this schedule, because remember, you have to start to figure out what the cost of goods manufactured are. You start with the beginning work in process inventory. This is everything that was added in, right? This is what you started with. Don't forget that. Okay, because remember, it's an inventory account. You're always going to have an opening balance plus everything, all the product costs added for this year. Okay, and then once you figure out what the total cost of the cost of goods that were all under production at some point for this year, then you're going to subtract out the ending work in process inventory. Okay, because that's still sitting in that inventory account. That means the cost of the finished goods, the cost of the completed goods equals $526,000. Okay. Questions? All right, everybody good? Don't leave yet, because now what I'm going to do is spend some time just going over what you can expect, okay, for the chapters that we are going to review. So the chapters are Appendix C, which is on partnerships. Chapter 13, remember that killer chapter. Make sure you go over the quizzes, okay. Chapter 7, that deals with the allowance for doubtful accounts, and actually and then chapter 16. Okay, so you have a lot of material. Okay, everybody's finished with the slide. I'm going to draw down another blank slide. Okay, good. Okay, remember, review all of these exercises before Thursday. Okay, so now, when we're talking about partnerships, okay, so, or Appendix C. Okay, Appendix C deals with what are you responsible for? Basically, the formation of partnerships. How is a partnership formed? What does it mean? Okay, when a partnership is formed. Partnership. Okay, you also have to know the different types of partnerships. And we went over the 3 different types, right? A general partnership, a limited liability partnership, and a limited partnership. I see there's a question. You still don't see the actual question? All right, let me go and I'll check again. Okay, if you don't see it, Joshua, just text me. Okay, I thought I did change the setting. Let me just make sure what's going on there. Okay. All right, so the formation of partnerships, the different types of partnerships. How is income determined in a partnership? Okay. How is income taxable to the partners. How is partnership income taxed to the partners? Also tax to partners, and very importantly, remember we spent some significant time on the division of partnership income. Okay, and then also how are partnership operating expenses handled? Partnership. Okay. So that's kind of an overview of what to expect about partnerships. Again, go over the slides, your notes, go over the exercises that we went through. Okay. Then we have dreaded chapter 13, okay, which was the statement of cash flows. Okay, and then remember, for the statement of cash flows, what immediately comes to mind when you think of the statement of cash flows? Who remembers? 3 different sections. What are they called? Lysander. Oh, very good. OIF, very good. The operating, investing, and financing. Perfect. Okay, Christian Dante, very good. Okay, OIF. All right. So remember, start with that. And again, the statement of cash flows basically details all the cash inflows and outflows, okay, in each of these 3 sections. Okay, please remember, you are only responsible for the direct method. Okay, and again, when we're dealing with the most important section, okay, when you're dealing with a company that has been in operations for a period of time, remember, is going to be the operating section. Okay, and we had gone over a bunch of formulas, okay, for that operating section. That is, how do we determine, and remember, in the operating section, the operating section is basically starts with the balances on the income statement, and then you're going to unaccrue the balances on the income statement by the changes in certain general ledger accounts, okay, over the course of the year. Okay, so a couple of the formulas that you need to remember is, how do we determine cash received from customers? Okay, how do we determine what the payments for merchandise by a corporation? How do we determine cash paid for operating expenses? Okay. Also, what activities, which activities are recorded in the other 2 sections? In the investing and financing sections? Okay. And just remember that in the investing section, you know that typically the purchases or sales of long-term assets, marketable securities, any issuance or payback of loans. Okay, those are the primary activities that get included in the investing section. Okay, and then in the financing section, remember you're always dealing with the financing activities for the firm that you're looking at. Okay, for the firm financing activity for the firm whose statement of cash flows you're preparing. Okay, and then the financing is going to be, again, sources and uses of cash from the sale and the repurchase of stock, for the issuance and retirement of bonds. And remember, the one tricky one also in the financing section is any dividends paid. Okay, remember, dividends paid by the corporation, always a deduction in the financing section, not in the operating section. Okay, that's one of those tricky ones. Okay. Remember that gains and losses, okay, if I ask you for the investing section, gains and losses on the sale of assets, long-term assets, okay, they don't get included, okay, in the operating section. Gains and losses are not included in the operating section. Remember, when you think of any statement of cash flows issues, you put your blinders on and you just think, okay, it's going to only regard the changes in the cash account. Okay, how do these transactions affect cash for the corporation? Okay. Then the next chapter is Chapter 7. Okay, remember the part of Chapter 7 that is included in this particular quiz is going to be the bad debt. Okay, the bad debt expense. Okay, you have to know about marketable securities. Remember, that was in a separate earlier section. Okay, so here for the debt, you have to know about how and why an allowance for bad debt comes about. Why and how it comes about. Allowance for bad debt account. Remember the allowance for bad debt account. What type of account is the allowance for bad debt? Again, what type of account? No, the receivable. No, it's not a receivable. Remember, it reduces the balance in the receivable account. So the allowance for bad debt is a very good. It is a contra asset. Excellent. It's a contra asset account. Very good. Okay, because it reduces the balance of your accounts receivable for estimated debt. Okay, again, why do we bother? Why do we have to bother putting this allowance account, establishing the balance? Because of the fact that we want to be in compliance with the matching principle. Okay, so even if the sale occurred in an earlier period, okay, remember that we want to make an estimate of the amount of bad debt. Okay, that basically was incurred because of the sale in the particular earlier period. So it is to be in compliance with the matching principle. Remember that there's two different ways, two methodologies for estimating bad debt. Two methodologies for estimating bad debt. Okay, the first one is the balance sheet method. Remember, if you're dealing with the balance sheet method, you are going to analyze the changes in a balance sheet account. Okay, and the balance sheet uses, you have to prepare, and again, you would have to be given the aging schedule. Okay, in fact, how long have these accounts receivable been outstanding? Okay, so the balance sheet method uses an aging schedule. Okay, and the second methodology is the income statement method. Okay, again, a company can use one or the other. Okay, they just have to remember to apply whichever method they are going to employ. They have to do it consistently. Okay. Remember, the aging of the balance sheet method is the more accurate method because you actually know the amount of how old that accounts receivable is. Okay, because remember, think of it in your personal relationships. The longer your friend, you lend a friend money, the longer that debt is outstanding, the greater the likelihood it is not going to be paid back. Same thing in business. Okay, and Joshua, can you explain why the income statement method is not an aging schedule? Yes. Okay, because remember, for the balance sheet method, okay, you're going to get an aging of the accounts receivable. And it tells you, okay, how much of the current balance in my account receivable has been outstanding less than 30 days. Okay, how much of my balance in my accounts receivable basically overdue for 30 to 60 days. Okay, and then it will show you for all the different tiers how long that debt has, how long the account receivable has been outstanding. Okay, on the income statement method, okay, everybody likes the income statement method because it's easier. All you're always going to do is just take a percentage, whatever that percentage that you're told that they use, you're going to take the percentage, okay, times the amount of credit sales for the current period. Okay, so you're going to determine how much bad debt is going to be recognized for this period. You're going to take whatever percentage is given times the credit sales. Again, not the total sales. Okay, if you have cash sales, there's no doubt that a cash sale is going to be uncollectible. You collected the cash already. Okay, but under the income statement methodology, you take whatever the percentage you're told, whether it's 2% or 3%, you multiply it by the total credit sales for that particular time period, and that is going to tell you the amount of for bad debt expense for that period. That's going to tell you the amount for the current period that should be credited to the allowance for doubtful accounts. Okay. All right, so it's much easier, okay, to do if you use the income statement methodology. It's much easier to determine that balance. Okay, but again, the balance sheet method is more accurate. But again, it's based typically on whether you're able to access this information from your general ledger system. How sophisticated is your general ledger system? Okay, but a key difference, okay, and I want you to remember this. What's the key difference between the balance sheet method and the income statement method? Okay, remember that the balance sheet method, okay, don't forget this, okay? The balance sheet method always takes into consideration, okay? It always considers the existing balance in the allowance account. Right? So if you want to replenish your allowance account, if you use the balance sheet method, you always have to consider, okay, how much do I have in that account right now before I increase the balance? Okay. When you use the income statement methodology, you are always going to ignore, okay, ignore the current balance. Okay, in your allowance account. Okay, so again, it's easier. The income statement methodology is absolutely a much easier way. Okay, but if you want to be more accurate, the balance sheet method gives you that. Okay, and again, GAAP requires, okay, GAAP requires that one of these two methodologies be used, either the income statement method or the balance sheet method, okay? There is another method for writing off bad debt, okay? It is not section per GAAP, okay? You can only use this last method if you have very little credit sales, and that is called the direct write-off method. And remember, under the direct write-off method, there are no allowance accounts established. What happens is that if somebody calls you and tells you, you know what, I can't pay you the receivable that I owe you, okay, all you're going to do there is going to debit bad debt expense. You're going to debit the bad debt expense, and you're just going to credit the account receivable. You do not have to establish any allowance account, okay? Again, it is only allowed if you have a very low amount of credit sales. And who else, again, the reason why accountants always are employed, okay, is because who else requires that you use the direct write-off method for accounting for bad debts? And who else requires that you use the direct write-off method? Again, GAAP says you have to use one of these two methodologies, the tax rate, IRS. So GAAP says you have to use one of these two methodologies to account for bad debt, one of the allowance accounts. However, the IRS, yes, says, I don't care about your estimates. Okay, I only want to know about the real deal. I only want to know who actually told you that they can't pay you. So again, the direct write-off method is required for tax purposes. And again, there's no estimates in the write-off method. Okay. Let me see. And then the last chapter, okay, I'm gonna, does everybody have this? All right. The last chapter then is going to be, the last chapter that we're going to review, and we kind of went over it today, is the manufacturing operations. Chapter 16. And again, we're going to continue with the manufacturing operations in chapter 17 at least. Operations. Okay, so if you're walking down the street, Lysander, you're walking down the street and somebody says, okay, if you're a merchandiser, how many inventory accounts do you have? How many inventory accounts does a merchandiser have?
3.
He fell for it. Merchandiser.
Oh. Oh, one.
One. Don't fall for it. Okay, very good. You fell for my trick. And however, when now we started looking at the manufacturers, financial statement, remember for a manufacturer, they're going to always have 3 inventory accounts. Remember, if it's an ongoing operation, 3 inventory accounts. Remember, if it's an ongoing operation, that means you're always going to have opening and closing balances in those 3 inventory accounts. Okay. And again, as we did in the homework for today, okay, understand how costs flow, okay, basically from the direct materials or from direct labor and manufacturing overhead, how basically those flow into the work in process inventory, then finally to the finished goods inventory. Okay, you have to know, as I did today, how to prepare. I'm giving you a big hint. how to prepare a cost of finished goods schedule, finished goods manufacturing. Okay, so be familiar with that. Okay, something that I mentioned when we first started this chapter was something called a value chain. A great term to know for finance, for accounting. A value chain is basically all those activities and resources needed to deliver a service or a good to the final customer. Okay, so all the different user departments, again, it goes from supplies to production department, okay, to the finished goods account. Okay, and then to the final customer. All those departments that are basically necessary to get that good or service to the final customer. Okay, we need to know how to make our own. No, you'll have to know how to put it together, just like we did for the homework, Joshua. I'll give you that information, and then you have to know, okay, how do I do that? Okay, how do I put that schedule together? How do I apply the costs generated there to the goods manufactured? Exactly what we had there in that problem. Okay. All right. Let me see. Oh, also remember that for when we did, just to go back, when we went back to to chapter 7, remember we had discussed 2 ratios. Chapter 7, we had discussed 2 ratios with regard to accounts receivable. And those ratios were the account, the inventory turnover ratio. Inventory turnover ratio. Inventory turnover ratio. And the nowadays, and the number of days in inventory ratio. And actually how to calculate the number of days in inventory. How do we figure out the number of times that inventory turns over, okay, in a particular company, and then also the number of days that in the year that the average piece of inventory is held onto. Okay. I think that's about it. Okay. Any other questions from you? All right, so we're going to have our quiz on, we're going to have our midterm on Thursday, and then we're going to continue with chapter 17 next Tuesday. Okay. And job order costing, we'll finish that one next Tuesday. questions? If you have any questions, you can email me. Joshua, I'm going to go look now at the, when we finish this, I'll go look at the settings for the quiz to see if I can make that a bit available so you can see the actual questions. Okay? And if there are no other questions, again, our exam begins at 10:05 on Thursday, an hour and 30 minutes. Good luck to you, and then we'll start.
Francisco asked, sorry, Professor. Francisco asked a question in the chat.
Okay, sure. The bigger the number of turnover ratio is, no, actually the number, you want the number of turnover of inventory, you want that number actually to be higher. Okay, but you want, then when you take the 365 days divided by that turnover ratio, you want the number of days to be actually lower. The number of days that it's held in inventory, you want that number to be lower. Again, because why does a company buy inventory? Basically to sell it. Okay, so you want a higher inventory ratio, but the number of days to actually sell the inventory, you want that to be lower. Okay, so you have to know how to calculate both of those. Good question. Okay, all right, Denise, so you're welcome. Okay, everybody work hard. Okay, I'll look at the questions for the quiz, and good luck on Thursday. If you have any questions before then, you can text me. Okay, Lysandro, Manfred, everybody work hard. Okay, this is the time to really, you know, all right, work hard. Stay healthy, wash your hands. Don't forget that. You're welcome, Christian, Jeffrey.